Ever wonder what financial advisors have to say about money goals, the market, or economic issues? Then this podcast is for you. Behind the Designs gives you a sneak peek into the internal conversations at Financial Design Studio. Michelle Smollenberger, a certified financial planner and the CEO here at FDS, will be your host and guide. Welcome to Behind the Designs.
Welcome back to the podcast. I am your host, Michelle Smollenberger, CEO and financial advisor here at Financial Design Studio. And today we are talking about the biggest risk to your financial plan. So today it's just me, and normally I have a sidekick, so this feels a little bit strange. But we're actually talking about something I think really, really important to your financial plan, and really that's the biggest risk. So we are going to get to what the biggest one is, but I'm actually going to give you what I believe are the top five. And we're going to talk through these, why they're risks. And I see these a lot. So when I talk with potential clients and existing clients as we work year after year on their plans and the things we see, this is kind of how I would sum up the five biggest risks. So first, let's define what a risk is. So I think it's really helpful when we can say, okay, a risk is, as the definition says, is a situation involving exposure to danger. And I love how there's always like multiple definitions. So a secondary definition that I saw is the possibility that something unpleasant or unwelcome will happen. I think I like that one probably a little bit better in this context. One of the things we always try to be careful of as financial advisors, or just us specifically, is that we never want to scare clients into action. So we never want to make you take action or move out of fear, but more just that, hey, I know I need this and it's time to get started. So that's why I think I like that second definition a little bit better. So when we talk about risks, there are so many risks that, it's funny, I was actually asking my husband, what do you think are the top five risks? And he was trying to guess them. And there are so many risks that we could detail and we could list out. And so when I'm, talking about these, I think you'll kind of step back and kind of be like, okay, each one kind of groups a lot of different risks inherent in it. So risk, that is our definition, just the possibility that something unpleasant or unwelcome will happen. And that is what we're trying to avoid by creating a financial plan and then implementing that year after year as life changes, because it will. And so that's why we're always updating your plan. So let's jump into what these five are. Now, you would always expect from any good financial advisor, financial planner, when you ask this question, what are the biggest risks, that they would say, it depends. And so it does depend. However, I do think that these all five apply to anyone. So let's jump in. Number five. So a list of five. The last one is going to be what I think the biggest risk is. The first is just not having a plan. So having no plan in place. When we think about a financial plan, this is where we always start with clients, really putting this, where is it that I want to go in the future? What goals do we want to accomplish? How long do we want our money to last? When do we want to retire? And what do we want to be using our money for and towards? That's what that plan is for. It really puts those things onto paper, puts numbers behind those, and really answers the question, can we do everything that we've said we want to? And so you'll hear us talk a lot about clarity and confidence. That's what we aim to help clients achieve. So clarity really comes from the financial plan. So we say a financial plan brings clarity. And the other thing that we always, will say is financial planning. It's always happening. It's not just a one-time event. And it's interesting because as we work with clients, just thinking this week, back in December, we'll do plan updates for clients. And that's really just to let clients, again, be confident in their plan, that they're on track, that everything that we assumed was going to happen is happening, or that, it's better than we were assuming, because we always want to use conservative assumptions. And so back in December, we had done this plan update for this client, and then we literally talked to them on Monday, and both of the spouses lost their job last month. And, no one plans for that. No one knows when things are going to happen. But again, back to risks, where we say the possibility that something unpleasant or unwelcome will happen. These are things that can happen. It's unpleasant. It's unwelcome for sure. And I share that example again, not to scare you into getting a plan in place and paying attention to your finances. I share that because actually the really cool thing about this client was that they've been doing all of the things in their plan. They've got an emergency fund. They've got excess cash set aside. So they are going to be fine. So we are actually spending time during the phone call or during our Zoom call talking about how, as they're looking for new jobs, really considering the industry that they're going to be in, and is that job going to be there, that business going to be there, and things like that. So we actually spent a lot of time just saying, okay, just, be thoughtful as these things are happening, and let us know as you're making decisions so that we can help you, with anything that might affect their financial plan. So we just never know, but that right there is an example of how financial planning needs to be an ongoing thing, because life happens and these risks are out there. And so we want to know that you're going to be okay when they do happen. So that was actually a really cool story. It was just really nice to be able to encourage them, because when you're in a hard situation and you're trying to deal with the outcome of that, sometimes just someone else coming alongside of you and just saying, hey, it's going to be okay. Remember, this is why we did all these things and you're going to be fine. And I just think that's helpful to hear. And so I just want to give you that example. So no plan in place. Now, when we talk about this, that plan, some of the risks that come with that is outliving your money or, premature death. Maybe one of you passes away earlier than you planned, higher healthcare costs in retirement, just personal liability, that you might have when you're out and about, if you get into an accident, things like that. This is really some of the, more technical risks that we're really trying to help in creating that plan. These are some of those things that you're trying to avoid or prevent. So not having a plan in place, that is number 5. Number 4, I would say the fourth biggest risk is not getting started. So you can have that plan in place, but if you never actually get started, it does you no good. So a plan without any action really does nothing for you. Growing up, there was this saying that I remember seeing maybe like 2nd or 3rd grade, and just a famous saying, when the student is ready, the teacher will appear. And at first, because I was younger, I didn't really understand what that meant. But now, within a couple of years after seeing that, I started to understand, because I always thought, well, I'm a student, I'm in the classroom, the teacher's here, the teacher's appearing, I'm ready. But when you really think about that saying on a deeper level, when you, the client, are ready to really focus on your finances and, kind of dig in and say, wait, can I accomplish everything that it is that I want to? And I want to get help because I realize that I don't know everything. When you're ready, the advisor, that teacher, will appear to help you along the way. And so I just, think about that famous saying that when I saw it years ago, it just kind of comes back around every now and then. I think it's so applicable. When we're really ready to get started, there's going to be someone there to help us through that. And that's exactly what we do with our clients. All right, so number 3, we're going to spend a little bit of time on this one. The third biggest risk is actually the market and investing. When we talk about investments, the risk here is not just a down market, or not the market being down for 1 year, but even just a sideways market or the market being down for a decade. And so a lot of times when people are investing their own money, and when you start your careers, you start adding money to your 401ks, you start adding it slowly over time, and you invest it in the funds you have available, and you're wanting to see that money grow. You just want to see it grow so that at some point in the future, you can retire. As you near retirement, as you retire, you need that money to do something different. You may need it to still grow, but you also, for the most part, need it to be there when you actually need to take the money out. And so the way that you are investing has to change at each of these stages in your career and in your life. So I want to talk through this a little bit more. When we talk about the market and just the risk, there are so many types of risk within the market, but this is going to be a top level of why investing matters in your portfolio and why this is such a big risk. So investing, professional help really does matter because there's just a lot that you may not know. People we are trained in this. This is what we do. We know how to actually look at things technically. There are certain charts that tell you things that if you aren't trained in this, you wouldn't know and you wouldn't be able to understand or realize. The biggest thing with investing is diversification and rebalancing. So what that means is that you own a variety of investments. So you don't just own U.S. tech stocks, but you own some large, some small, medium-sized companies, and then also some international, some bonds and different types of bonds, things like that. You own a variety and a diversified percentage in each of those categories so that if something were to happen in the market, you are not going to experience a large drop because you had everything in that one place. That's what diversification does for you. You are protecting your investments so that you're able to weather whatever the economy is doing, because it's very rare that everything goes down at once. And, 2022 is actually an example of that. Very rare time in history when stocks and bonds went down at the same time. It happens so seldom. And so this is where even within that, you've got to know what you own. So diversification, being diversified across different investments, but then the rebalancing of that. So one of the biggest things that I love about our process when we're investing clients is, we might say at a really high level, we want to own 60% in stocks and 40% in bonds. Now, within each of those groups, we're going to own different percentages of different types of stocks and different percentages of types of bonds. But at a high level, we're going to say we want to have you in 60% stocks, 40% bonds. Well, what happens is if the stock market moves higher over time, so now that 60%, your investments are growing. And so now, let's say you own 70% in stocks because the market has moved higher. Within kind of like a band, we would say, okay, we don't want to own too much. So if, let's say they've increased in value, now it's up to 70%, we would say, wait, that's too much. We don't want you to have that much in stocks. So what we would do is we would sell some of those stocks because they've moved higher. We would sell some and move those into bonds. So that's going to move them from that 70%, and we're going to reallocate that back to where we're moving. See how we're selling stocks at a high. So we're selling 10% of that to get you back to the 60%, and we're moving that into bonds to get you back to where you want to be. As we're doing this rebalancing approach, it's a disciplined approach where Rob is looking at this every day. He sees client portfolios, and when something is out of balance, he can actually go in and change to where we get them back on balance. And what this does is when you own too much of something, you're selling it when the prices are higher and you're buying them when they're lower. So it actually makes us do what we want to do. We want to buy investments low and sell them high. So it just makes sure that we're doing that. What I love about this process is it's a disciplined approach. It's something that we do and we follow for all clients. So we always know that you're on track to where you want to be. If you don't do that, it's very easy to where you could get to where you have 80% in stocks because the stock market has done wildly well, and now you own way too much in stocks. Let's say you're someone nearing retirement and you have such a high concentration of stocks. The day you retire, the market, starts to go down over that first year. Well, that can really change the outlook of your plan over the years ahead. That's why this rebalancing matters, because we want to make sure that you always have the right percentages in the right types of investments. The other thing that I would also say is it's just knowing what you own. So again, kind of back to this example, when you start your career, you start investing, you add money and you want that to grow over time, and you just kind of choose, the best performing funds. One thing that most investors don't really know is what is in those funds that they own. So it's very common. You get a list of the investment choices that you can choose from, but I don't know how many investors actually dig into each of the funds that they can invest in to see what companies are actually in this fund. And so that's something, is knowing what you own. That's one of the biggest things that we do for clients when Rob is picking between the bond funds that we want to own. For example, as inflation has increased so quickly over in 2021, 22 into 23 now, and interest rates, that really creates very unique environments for bonds specifically, also stocks, but you've got to know, because we can invest in different types of bonds to be able to not see the large drops in the values of those funds just by knowing what we should own in different rate environments. That's really what you're paying a professional to know and to understand and to invest you in the right things at the right time. Now, what you'll notice I didn't say was that we're not timing the market. We're not picking one right investment that's going to be the perfect investment, and we're not getting at it at the exact right time, and we're not getting out at the exact wrong time or right time. What we're doing is it's a disciplined approach so that over time, as we make these changes in the allocation, we're just forcing what we want to happen. We're selling it when it's high, we're buying it when it's low, because we're just disciplining ourselves to say, you know what, when we own too much of this type of investment, this asset class, by this percent, we're going to move it to this other one that's not performing well, because then when it starts performing well, then we can put the funds back into something that isn't. And so you just see how this process simply leads to investing at the right times, or very close to the right times, in the different types of asset classes. That's exactly what our investment process is for clients. This is actually why it matters so much. If you don't have a process like this, or you're not following something like this, and you simply buy and hold, back in the early 2000s when the tech bubble happened, you can look back at stock market charts and you can see that the market dropped because of the tech bubble. So we went through that, and then it moved higher, and then dropped and moved higher. And it actually there were periods of time where it took like 10 years before you got back to the starting point of where you started. So the market went down and higher, but eventually after that 10-year period, you were actually just in the same spot. So because you bought and held the same investments, you actually just moved sideways. Of course, you went down and up, but ultimately, when you step back and you pan over that 10-year time period, you actually just went sideways. This is exactly what a rebalancing approach prevents. We don't just want to be moving sideways. Essentially, what we're doing is, by rebalancing, so when stocks moved higher by that 10%, we said, okay, we're going to move some out of this or some into it. And we're just picking up a little bit. We're basically saying we want to lock in that gain, and now we're going to move it into something that we think is going to grow next, or grow further. And so we're just reallocating it so that we pick up a little bit of growth, or we avoid some loss in areas just by the disciplined approach that we're doing. And that's really one of the biggest keys, is when you buy and hold, you're just kind of subject to whatever's happening in the market. And, everyone would say that, if you're investing, no one is in control. No one knows what's going to happen tomorrow. And we don't pretend to know that either. That's actually one of the really humbling things about investing, is that you can say, I bought Apple or Amazon. But when you look back, that's the only time you're going to know if that was a right call or not. Nobody knows what's going to happen tomorrow. And so these are the things where we're saying, you know what, we want to be really disciplined about this. We have a process, we follow our process. And when we look back over that through 2020, 2021, what was really cool is, as the market has been volatile, as it's moved higher and lower in some pretty big swings, when the market was low, those were the points where we were moving money out of bonds into stocks. And so as stock prices had come down, we're essentially putting more money in at a low point. So you're picking up more of that growth as it goes up. Then when the market went right back up, we got growth on a larger amount of dollars. So now when it went back up to the top, we held too much in stocks. So you see how we just now moved it back into bonds. You're basically picking up a little bit of growth. You're also avoiding some of the losses along the way. And collectively, when you compile and compound all of those changes together, that's where you just pick up a little bit more on your investments. And so We're not, not saying that we're picking the right or perfect investments or the perfect timing, but when you look back, a disciplined approach can get you really pretty close to where you want to be, or at least you're taking advantage of some of the opportunities that are available just by these little changes rather than just buying and holding and just writing it out to see what happens. So that's really the risk that we're trying to avoid, is not a bad stock market, a bad year in the stock market, or a bad day, but a bad decade, because that can really have an impact on your overall plan. So the market, it's kind of a really big way of saying the market is a really big risk, but I would just say how you're investing in the market. And this is the reason this is one big risk is because so many people, this is an area that it's interesting and it's exciting, and people love to pick, an investment and see, am I good at picking investments? Am I good at picking these things? It's kind of like, it can be like gambling where you can get addicted to it and you feel like, oh, I'm really good at this. This is the thing where we're not doing this by trial and error. We're doing this from experience and knowledge and study and all of the years of, Rob doing this. And these are the things being trained in. What is it that we should be looking for and techniques like that? So that's the thing why investing really matters, and having professionals who are helping you do that, because wherever you're at in your plan, you want to make sure you're investing the right way for where you're at that time. All right, so the second biggest risk kind of follows right after that, is really missing out on opportunities. So one of the biggest things that I see with clients, and probably one of the most exciting times that I see with clients, are when they actually make these decisions in their plan that kind of don't follow their plan. And I'll give you some examples, and I don't mean that in a negative way. They don't say, "Hey, we're gonna go do this crazy thing that was not in our plan, but it's gonna hurt our plan." I mean it in a good way, where they said, "You know what? We're gonna retire earlier than we thought, or we actually are gonna sell our home. We were planning to do it this summer, but and as we talked, we said, let's actually just, if you can sell that like 3 months earlier, if you could get it listed right now, because of what the market was doing, they did, and they were able to rush to do that, and they saw a much higher selling price because they were willing to kind of speed things up a little bit, and they really benefited from that. So these are the opportunities that I say when we're doing your planning, and we're kind of in, I call it kind of constant conversation. As things come up, our clients will email, "Hey, I have a question about this, got this note from my employer," or we're reaching out throughout the year. There's natural times like tax planning or open enrollment that we're helping our clients make these decisions for in times like that, but also during the year. As we're in these conversations, it allows us to kind of share what we're seeing. We talk to, all of our different clients who live all across the U.S., so we see different things like with the housing market, and it's been interesting in the last year where we see what are the opportunities for clients who are selling, who are buying, who are moving, and so these are some of the ones that I've really noticed is just the timing of when they've done it and what's been going on in the market. Right now is kind of another unique time in the housing market, so people that are thinking about moving, interest rates are not low, but it's interesting because there's so few houses out there for sale. Housing prices are actually staying pretty high, and so that really benefits sellers if you're still trying to sell a home. So I think that's some of these just really interesting opportunities. One of the things is that when we talk about opportunities that you have, so when we say, sometimes you miss out on these opportunities. So back to this client who, was willing to list their house a few months earlier, it kind of rushed them. But what can happen is when we look in hindsight, sometimes these opportunities that we could take actually turn into costs. And so what I mean by that is back to this example of a client who, hey, let's just speed this up a little bit faster because of what we're seeing right now. We think you could, take advantage of the timing on this. Let's say that they hadn't and they were kind of back to their original timeline. When we're setting goals and when we're putting numbers in a financial plan, we do have to make assumptions. And so in this case, let's say that we had assumed that this client was going to get, a set dollar amount when they sell their home. Well, by waiting, the market did cool off. And so a lot of the offers that were being made that were above asking price when they actually sold, those did go away kind of back towards the time that they were thinking that they would actually start to list their home. So there are times where in your plan, if we say this is what we can get and we build a number in, and let's say that you don't sell it for that value, it actually kind of does become a cost, because if you don't get those values or those assumptions aren't quite what we thought they were going to be, something in your plan does have to change. Now, it may not affect it in a really large way, but what I'm trying to get across is that sometimes, these opportunities actually become costs when we look at them in reverse if we don't take them. And I think sometimes missing out on these opportunities, I think sometimes the opportunities that people are presented with, I think it's kind of scary, because it's a change to what is in my mind and what I've been thinking and the timeline that I had. And so those people that are able to say, you know what, yeah, we can make that happen. I think that makes complete sense. And you talk it through. So it's not, just kind of like a fly by night quick decision. But I really believe that people that kind of take that opportunity kind of have this mindset of, yep, I've had enough gain. I'm going to take my gains and move it into something else. I think that opportunities, they just work out for them. They don't become costs. They don't become opportunity costs. Rather, they just add to their plan, and it adds to then the opportunities that you have in the future. So when we've seen that, I think that's why I say that's like the most exciting for me, because it's usually really exciting for them when they experience that they kind of took made a little change to their plan and they saw it work out for them. And so I think that's why it's exciting, because we see the difference that it makes. And also they kind of trust the process a little bit more. They realize, oh, you know what? Like, that was really helpful that we were able to talk through that. You had really good, guidance to share, and it made sense. And it was a team effort. We all really worked on it together. One of the things when we're talking about some of these areas and opportunities you can miss out on, just a really big one that people, we talked about investments, but another area that's huge is taxes. And we do a lot of tax planning. We're going to link to a tax downloadable guide that we've created really for, any prospective clients. There's tips and ideas in here for tax strategies that you could utilize. But what we really wanted to do was to help you see the real dollar value of some of these strategies and making some of these changes. I think a lot of times people can look at, maybe tax planning or, if I do this or this, it makes a little difference. When you compound those changes over time, though, you really see how it impacts your plan. And so we're going to link to that in the show notes, our tax downloadable guide. So that's tax savings strategies that you can get, and hopefully that's helpful. There's several little tips and tricks in there. All right, I'm going to talk about the biggest risk to your financial plan, and the biggest risk that I believe to people's financial plan is actually yourself. I believe that, you are the one that can make all of the decisions, all of these other factors that we've talked about, whether you have them in place, whether you do these things, it all hinges on you. And the other word that I want to look at the definition for is the word choice. And the definition of the word choice is an act of selecting or making a decision when you're faced with two or more possibilities. And the reason that I thought about the word choice is you are the person that has the choice to choose all of these other things that we've just talked about. You can decide whether you get a plan in place, whether you don't get a plan in place, whether you start today, whether you actually implement that, whether you invest yourself, whether you get help investing because you aren't quite sure. You know that there's a lot you don't know. You also have the choice. Do I make these little changes? Are there opportunities I'm going to take? I believe that people themselves are the biggest risk to their financial plan because they have the choice to make all of these decisions. And at the core of this, it's really just deciding to get started, to make sure you have a plan, make sure that you're following that it's being updated so that you can actually see, you have the clarity to see that you have a plan in place, how it's going to work out, given a lot of assumptions. And then also that gives you the confidence, to where you can actually believe that your plan is possible and to where you actually believe, okay, this is where we're going. And it's kind of like a team. When you have one goal and you're all rowing in the same direction, it's so much more exciting as you get and reach that goal because you know where you're going. And so everybody can see, hey, we're getting closer all along the way. But if you don't even know where your goal is, it's not exciting, even if you're like really close to it, because nobody knows where you're actually trying to go. So I believe that you are the biggest risk to your financial plan. And, it might sound kind of cheesy, or it might sound actually kind of weighty, because that's kind of a big weight to put on your shoulders to say, you know what, I do need to get started. The great thing is that you don't have to do it alone. You aren't on your own. There's a lot of people that are trained. We're trained exactly for this, to help our clients, so that whether it's retirement, we've retired 100 times, so you can retire once and you can retire for good. So we're going to help you along the way. If it's tax planning or investments, whatever the topic is, we're going to help you do that. These are the things that we're trained to help you do. So if this has been really helpful to get you to kind of start thinking about what are the biggest risks in my plan, and you find yourself just saying, yeah, you know what, I'm the biggest risk. I really can't. I need to get started. There's really nothing else stopping me. You can feel free to check out the show notes, but also just go to our website, financialdesignstudio.com. We've got a button there that says Get Started, and that walks you right through the process to where I will walk you through the next steps and getting started. And it's so exciting when people decide, all right, I want to get a plan in place, and I want to know where I'm going, and I want to know that it's possible. It's really exciting to watch that process take place, to know that you're going to be in the place that you want to be. So until next time, we look forward to hearing any questions that you have, or checking out any of our other podcast episodes. But we will see you in our next recording. All right, bye.
Thanks for tuning in. If you like what you hear in our podcast, please subscribe. We release new episodes every other week. And quick note, the content discussed on this podcast should not be taken as financial advice. Financial Design Studio accepts no responsibility for your individual actions or choices. But for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. We'll see you in the next episode.